Welcome back to Alpha Recap, your weekly market digest from stockalpha.ai. We're recording after the close, so we'll walk through what happened this week and why it matters. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. What really stands out here is how concentrated the market story felt. Basically, two big secular threads and then valuation everywhere.
Right. The three dominant themes the research team kept coming back to were AI, compute, and platform leadership, the rapid revenue inflection in biopharma tied to GLP-1 and metabolic franchises, and this broader valuation reckoning where leaders are trading at premium multiples.
Yeah, and to add to that, markets closed with tech strength overall this week, and you could feel the narrative flow into a few stocks we cover in detail.
Let's dig in. First up, Splunk. The report framed this one as a cloud transition story with a premium price tag. Splunk finished last quoted at about $157 and was described with a price-to-earnings ratio of roughly 103.
Analysts highlighted that Splunk is migrating from on-prem licenses to subscription, cloud-native offerings. ARR momentum, margin expansion, and AI monetization are the three things people are watching before the market gives it a durable re-rating.
But the research leaned neutral, basically saying the narrative is in place, but the current price already reflects a lot of those expectations. So near-term upside looked limited against the consensus price target of about $150.
Right. That's a classic story priced in situation. Execution signals like sequential ARR growth and improving gross margins will be the proof points the market needs.
Next, Okta. The team called out a less crowded re-rate case, non-human identity and AI agent security. Okta closed at about $84, and management is guiding to roughly 11 to 13% annual revenue growth as it transitions away from hypergrowth.
I mean, when you step back and look at this, the idea of managing machine identities, agents, bots, services, could expand contract value if it actually scales. But execution and hyperscaler competitive responses are big caveats.
Analysts stayed neutral overall. They were constructive on the product idea, but clear that valuation and execution risk keep the stock from a clean buy thesis in their view.
Short reaction.
Bill.com. The Bill story was one of the week's momentum names. Fiscal third quarter marked the company's first quarter of GAAP profitability, with core revenue growth of about 16%. That pushed a lot of analysts toward a strong buy stance.
Yeah, and markets reward that profitability pivot. But researchers caution the valuation premium makes it sensitive to macro slowdowns or a deceleration in growth.
Exactly. The takeaway was that moving from growth at all costs to profitable, cash-generative models is being rewarded. But it also raises the bar.
DocuSign came up too, closing at about $48 and trading at a price-to-earnings ratio near 30. The theme there was intelligent agreement management through an AI partnership to boost workflow automation and enterprise spend.
The research said the AI partnership is promising, but DocuSign still needs clear evidence that integration increases average contract value and renewals. In other words, show me measurable revenue acceleration.
Short reaction.
Vertex was one of the clear healthcare winners this week. First quarter revenue came in at about $3 billion, and earnings per share were $4.47. Also notable, German reimbursement for Casgevy and accelerating demand for certain launches.
That reimbursement update shifted the narrative. Analysts moved bullish, assuming continued commercial traction. This is a good example of how payer decisions can materially change estimates and multiples.
The research emphasized that commercial success, not just clinical data, is what's increasingly moving the needle in specialty pharma valuations.
Intuitive Surgical was a reminder of the opposite. The stock was around $450, and while Q1 results beat and cash generation looked solid, there was a recall of certain stapler reloads.
Yeah, and that recall is exactly what the team flagged as a short-term sensitivity. Device-specific regulatory issues can compress expected cash flows quickly, especially when recurring consumables are a big part of the model.
Danaher traded near a 52-week low after mixed first quarter results and one-time acquisition charges. The research framed this as a possible valuation reset if integration execution improves.
Right. Danaher, around $171, was presented as an acquisitive, diversified life sciences play, where the derating could create a constructive forward valuation, but only if they can prove earnings quality and integration success.
Eli Lilly continued to dominate the GLP-1 conversation. The stock finished the week near $950 and carries a price-to-earnings ratio of about 35. Analysts stayed bullish based on GLP-1 leadership and manufacturing expansion.
The risk there is payer pressure and competition, notably from Novo Nordisk, that could pressure pricing or share. Still, analysts emphasized that strong commercial execution could justify the premium.
And of course, the NVIDIA story was everywhere. NVIDIA closed at about $215, and the report underscored its dominant position in GPU and AI compute. The research noted an implied market cap in the trillions, roughly $5.2 trillion, as a way to highlight the scale.
That valuation number always sounds wild out loud. The point the team made is simple. NVIDIA captures outsized profit pools from data center spending, but the stock is richly priced and highly dependent on sustained hyperscaler demand and product leadership.
Short reaction.
Let's pull out the cross-sector patterns the research team emphasized. First, AI was a thread across hardware and software. NVIDIA anchored the compute layer, while Okta, Splunk, and DocuSign were all pitching AI as a re-rating lever.
And it wasn't just feature changes. The analysts argued AI can actually redefine contract structures. Higher average contract values, new non-human identity lanes, and increased product stickiness.
Second pattern, profitability transitions mattered. Bill's GAAP profitability quarter contrasted with Splunk's long migration to subscription economics, two different routes to market credibility.
Markets were increasingly rewarding operating leverage and cash conversion, they noted, and penalizing companies with premium multiples but uncertain margin paths.
Third, healthcare bifurcation. Vertex and Lilly showed how reimbursement and commercial rollout can rapidly change valuation, whereas device recalls like Intuitive's can do the opposite.
Fourth, derating creates selective opportunities. Danaher's pullback after acquisition noise might open a differentiated entry point if integration improves and cash flows reassert themselves.
Those were the broad connections. The team also highlighted three contrarian takes worth flagging. Splunk's neutral stance despite cloud momentum, Okta's focus on non-human identity as a less crowded re-rate case, and Danaher as a potential value reset story.
I like that point on Splunk. It's easy for markets to assume cloud migration automatically equals re-rating, but analysts wanted to see measurable ARR and margin proof before agreeing.
Let's talk methodology briefly, because it matters how they reach these conclusions. The team leaned on cross-sectional valuation comparisons using price-to-earnings ratios, revenue quality measures like ARR and subscription mix, and a special emphasis on GAAP profitability inflection points.
Event mapping was another important technique. Reimbursement events, regulatory outcomes, AI partnerships, and product launches were all mapped to timing and probability ranges to estimate valuation impacts.
And for AI-dependent names, they did sensitivity analyses around hyperscaler CapEx cycles, data center orders, and GPU inventory, because demand here is nonlinear and can swing earnings materially.
So what are the practical implications for listeners at a high level? Analysts emphasize that premium valuation names are increasingly binary. You need continued leadership and demand to justify those multiples.
Profitability inflection matters more now. If a company moves to GAAP profitability or shows a clean recurring revenue mix, that can reduce multiple risk. And regulatory or payer outcomes remain high leverage events in healthcare and devices.
Also, AI adoption creates structural winners but concentrates risk. NVIDIA is a prime example. Outsized market capture, but huge sensitivity to demand cycles.
Looking ahead, the research agenda suggested a few specific things to watch next week. First, company operational readouts, especially any new ARR commentary from Splunk, product announcements, or partnership disclosures from Okta, and follow-through quarters from Bill to validate GAAP profitability.
On the AI side, hyperscaler CapEx commentary and data center order flow will be critical. Look for cloud provider earnings or conference remarks that could indicate GPU demand durability.
For healthcare, watch for additional reimbursement updates for Vertex, and payer negotiations and manufacturing ramp commentary from Lilly. Those things materially change forecasts.
Also keep an eye on regulatory and integration updates. More detail from Intuitive on the recall remediation timeline, and Danaher on integration costs from the Massimo deal.
On the modeling side, analysts were planning scenario work. Layered models linking hyperscaler CapEx scenarios to NVIDIA revenue, payer sensitivity analysis for GLP-1 revenues, and integrated margin path studies for cloud transitions.
Uncertainties remain obvious. Demand durability for AI hardware, competitive pressures and pricing in GLP-1 and SaaS, regulatory and payer behavior, and M&A integration risk.
Before we close, let's hit quick company bullets so listeners have a fast memory jog, short and sharp. Splunk, about $157 and price-to-earnings ratio around 103. Neutral stance until ARR and margins prove out.
Okta, about $84. Management growth target roughly 11 to 13%. Neutral, but watch non-human identity traction.
Bill.com, first GAAP profitable quarter. Core revenue growth about 16%. Momentum flagged, but valuation sensitive.
DocuSign, about $48, and price-to-earnings ratio near 30. AI partnership is promising, but needs measurable contract value gains.
Vertex, first quarter revenue about $3 billion, and EPS of $4.47. Reimbursement wins are driving upgrades.
Intuitive Surgical, about $450. Q1 beat, but device recall is a near-term risk to consumable attachment rates.
Danaher, about $171. Derating after acquisition charges might create a constructive setup if earnings quality normalizes.
Eli Lilly, about $950, with a price-to-earnings ratio roughly 35. Bullish on GLP-1, but watch payer dynamics and competition.
NVIDIA, about $215, and implied market value roughly $5.2 trillion. Dominant AI compute exposure, but valuation risk if demand softens.
Okay, time for the 5 quick takeaways we want listeners to remember from this week's digest.
Number 1, AI leadership is central and cross-cutting. It's shaping both hardware winners and software re-rating narratives.
Number 2, profitability transitions are increasingly valuable. GAAP profitability or durable recurring revenue can meaningfully reduce multiple risk.
Number 3, healthcare outcomes are high impact. Reimbursement wins can lift valuations quickly, and recalls or regulatory issues can do the opposite.
Number 4, premium valuations are more binary now. Execution and demand continuity are required to justify today's multiples.
Number 5, watch the signals next week. Splunk ARR commentary, hyperscaler CapEx language, payer updates for Vertex and Lilly, and any additional detail on Intuitive and Danaher integrations.
Final reminder, this is all informational. Analysts noted probabilities and scenarios, not prescriptions. This podcast does not recommend buying, selling, or holding any security.
If you want to dive deeper on any of these names or ask the research team a question, head to stockalpha.ai and use the Q&A feature. You can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. Catch us next week on Alpha Recap for another look at the themes driving markets.
Yeah, thanks. And remember, if something in this episode made you curious, go to stockalpha.ai and ask away. See you next week.